All right, good morning, everyone. Welcome to the last trade findings and adjustments on Thursday, the 29th of April. It's the last one for April. Next week, I will get back to the Tuesday night trade findings and adjustments. I was just trying to give myself a little extra time to shake this cough off. I'm calling an audible today. I was going to redo last Thursday's Armstrong PDF and go over it one more time. Do so probably a little more civilly, but I decided against it. We need to talk about earnings. Now, I've built Hurley investments 100% around earnings. So I've built Hurley investments completely around earnings and the collar trade. So let's talk about a couple facts about earnings. When stocks go through an earnings event, what is the possible movement? I'm going to say on average. So what do you think? What do you think the possible movement on average is? Okay, so that's a broad range. And Dave, it's amazing you could say that so quickly. But you are correct. The possible movement is somewhere between 5 to 18%. You probably heard me say that in the past. But I got that, Ida. But I'm looking for something more defined than that. I'm going to tell you it's one standard deviation, which is equal to one Elliott wave, or 16.66% to 18% movement up or down. Now, we've done the collar trade. We use a collar trade, especially when we first start with people's money. We use the collar trade to protect their money. I am going to take a quick screenshot of our newest collar trade we put on the last 20 minutes. For those that I felt could afford it, we put in a Facebook collar trade at the end of the day yesterday. It was frustrating. It was frustrating because I was uncertain. I had vacillated about it for, I've been vacillating about it for weeks, would be the short answer. But it was Facebook. It was Facebook, and we basically did a last minute collar trade that we put in the last 20 minutes while the market was open yesterday. We put it in for people who had $95,000 or more. Well, that's not true. That had basically $150,000 or more sitting in their account. It was a $95,000 investment. And we entered a full collar trade on Facebook the last 20 minutes that the market was open yesterday. What is the problem with creating a collar trade and putting in 20 minutes before the earnings event? Well, it actually, putting in 20 minutes before the earnings event, we limit our upside with the short call. But that's part of the collar trade. I want to be more specific. What's the problem with placing a collar trade 20 minutes before the market closes before their earnings event? I want to be more specific than that, Bill. So there is a definite acute problem with putting a caller trade on 20 minutes before their earnings. So what is that exact problem? There you go. Volatility crush. Or I overpaid for the long put protection. So let's do our math. I mean, I really kind of threw this on all at once, right? Our cost basis is not 305. Our cost basis for the stock, right? So we bought to open Facebook at an average price of 308.32. We bought our long puts, bought to open long puts for a freaking $11, and I'm just going to round up to 68 cents. We sold to open, and that was long puts at the 310 strike price. And we sold to open, I should just put this way, May monthly, 310 strike price. And we sold to open short calls, June monthly, 350 strike for $2.89. So let's work our numbers, right? Overall cost basis is equal to 308.32 plus 1168 minus the $2.89 of credit, which gives us, I'm going to get a calculator out so that I get it right, 308.32 plus 1168 minus 289 gives us an overall price on average for everyone's accounts, 317.11. Now, when you look at this, I mean, we basically put on, between me and Keith, we stuck $1 million of Facebook on yesterday. To say I wasn't apprehensive, I was really, really, really apprehensive. But I kept telling myself overall risk in trade is 310 right to sell minus 317.11 equals $7.11. Everyone went in with only 300 shares. So let's do the math there. 711 times 300. We only had a risk of 21.33 on a 95K investment, or 21.33 divided by 95,000, a 2.24% risk on investment. So I sat through that yesterday realizing, holy crap, if this tanks, it's going to go to 250. Am I willing to stay in on Facebook down to 250? If Facebook can't find a way to beat Apple on their new, hey, do you want this website or this app to track you? Which I'm saying no all the time, to be honest with you. The new iOS 14.5 update on Apple phones gives you the ability to tell other apps not to track you. Only Apple can track you. Track where you've been, what you're doing, what you're seeing. Kind of a neat feature. But I kept having to come down. Okay, I just spent $95,000. The most they have at risk is $21.33. Let's go for the maximum reward. Well, 350 minus 317.11 equals 317.11 equals 32.89 times 300 shares, 9,600, 98.67, 98.67. You divide that by 95,000, right? And I'm just rounding on that. Basically equals a 10.38 2-month return on investment. I like it. Now, someone tell me, what is the biggest problem with trading an earnings event? Someone please tell me, what is the biggest problem with trading an earnings event? You could be wrong, okay, but the caller trade takes care of being wrong. In fact, if I can use that as an example, David, if we go to Facebook, if we were wrong, I was looking at this support level on Facebook, and I had the right to sell at 310. So if I sell at 310 times 300 shares, that gives me like $93,000. And I buy back in at 255, I get 364 shares. So I would almost pick up another 100 shares. It would have to hit this support level to be a full 100. And my problem was, will it break the 50? Will it break the 200? So just because it falls down, that is not a problem on earnings. In fact, I've got you protected with that. We're good. What is the biggest problem with trading an earnings event that basically totally screws all these people that are in stock ownership and leap long calls and directional trading? Not saying that leap long calls are bad, especially if you're doing it with profits of your caller trade. But think about it. What is the biggest problem with trading an earnings event? Okay, so David, another good guess. I want you to be more specific. You said the uncertainty, and you're right, because I know where you're trying to get, but I even want you to think about it just a little bit more. It's not necessarily the uncertainty, but the biggest problem after trading the earnings event, the market has to figure out what the earnings / guidance. So I'm going to give you a example because I believe I had it in here. I want to use Apple. Apple had their best earnings event ever, and they're down 92 cents or $1. Their best earnings ever. Well, Kevin, how could you say that? Well, they beat on everything. $1.40 versus 98 cents on their earnings per share. 88.56 billion of revenue versus an estimated 76.83 billion. They beat their revenue numbers by 12 billion. And let me state that one more time. They beat their revenue numbers by 12 billion. I mean, that's just that I can't grasp how stock analysts would miss a $12 billion. Well, everyone was at home. They can't do that again. Again, 12 billion against 76. Let me do the math on that. 12 divided by 76. They missed their revenue by 15.78%. They missed it by almost one standard deviation. 16.9 services versus an estimate of 15.57. iPad sold 7.836 billion versus 7.79. iPhones sold like 47 million iPhones versus expected 30. It's just outrageous. Profit margin 42.5 versus 38.8. We are talking about a performance that is unbelievable. Mac revenue 9.10 billion, up 70.1% from a year ago. iPad revenue 7.8 billion, up 78.9% from a year ago. I don't know what to say. Everything is on a tear. In fact, the comment that was made, everything is in a super cycle. Apple's going to spend another $90 billion buying back shares. That is insane. Yet, the stock is down today. Now, Facebook, the stock is up ginormous today, $16, because they had 48% more revenue. But they did have much less profit margin. So they made more because they spent more. And they made less profit on the dollar they spent this quarter than last quarter. Ford beat top and bottom line. They beat everything. But with earnings comes guidance. Beat top and bottom line, raise their yearly guidance. Can someone tell me what's wrong with Ford? Why, if he beat the top and bottom line and gave good guidance, why are they down 10% today? There you go. They're down 10% because they make cars and they're short chips. What does that mean in plain English, right? Ford is down today because they beat top line, they beat bottom line, they gave good guidance, even raised it a little bit, but their more expensive models, the Ford Expedition, their Ford Explorer with all the bells and whistles, they don't have the chips available to put into the cars to run all the upsells and gadgets that you want in your car. Well, Kevin, what do you mean? Well, I know a Ford Expedition Max Platinum has heating and cooling seats. I know they actually have a little massage thing in it. It has a moonroof that goes open and so forth. They have the camera for the back. They have a max towing package. They have a sound system that's second to none. They also have, if you want to, you can buy the media package so they can watch videos and stuff on little screens on the back of the seats. It's they did excellent, but they were upfront that the chip shortage will slow down 10% of the vehicles they can make this year. Yet they're still going to have a higher revenue than last year. One of the problems with trading on earnings event, the market has to figure out what the earnings guidance means, which means, and it's plain and simple, you never adjust your trade the day after earnings. Sometimes it's prudent to wait a week or more. Kevin, you're killing me. You don't wait a week. Well, we waited a week on General Electric. General Electric had a great earnings. They didn't get the love. They actually fell down to $12.90, bounced back up. They're holding 13. Yesterday, they're back up to 13.20. If you had taken all your protection, if you had cashed in or added protection the day of the earnings and they bounce higher, you lose. If all those poor people that took off all that protection on Apple first thing this morning, they lost. They took their protection off for a loss, and they're missing out. Well, we're actually losing 2,000 on it right now. We'll give it some time. But you don't take all your protection off right away. You give it a couple days for the market to digest and find out what it's going to do. And we still have the right to sell Apple at 135. I think it should be heading to 150. From the looks of things, it's probably going to go back and test 122, which is ridiculous because it had the best earnings possible. Ford, people are telling us on Ford, you should run it without protection. You're just going to be fine. No reason to need to do anything. Ford's making up half of the downward movement right now. And Ford's stop might be down at $10. That's most likely the stop it's going to take. So at $10, we're going to cash in our $12 puts and add another 10% more shares of stock. What else do we have earnings on here recently? Starbucks and Visa. Kind of funny. I think it's funny. Starbucks had pretty good earnings. We just have a couple calls on it here. Starbucks had some pretty good earnings and it dropped to 114. People in China haven't gotten back out to their stores apparently. But it was shocking that they had great earnings and they were down. Yet they're coming back nicely. They're back up to 114. They'll be up to 116 here shortly. Then go test 118. Good earnings, and the market punished them because their China numbers were not up to speed. All I'm trying to say and help everyone understand right now, all I'm going to say is that there's uncertainty around earnings. You never adjust your trade the same day. You wait 2 to 3 days, sometimes a week or more. What we built our business around is that standard deviation where a stock can go up 16.66% to the high side or drop 16.66% to the downside. The risk is not a stock falling down. Here at Hurley Investments, we take advantage of those drops to convert it to more shares as the stock rebounds. If the stock does not rebound, all we have to do is add a second insurance contract on it, and you're still going to be profitable on a company that went out of business. Are there any questions on earnings and why we play earnings and how we do it? Ida, you mentioned to cut the dividends on Ford, but they've cut their dividends for a while now. That is not something that came out at the most recent earnings. Any questions you guys have that I can answer about earnings events and how we plan to do them, how we use the collar trade, and the reasons why? David, nope, Dave, are you saying it doesn't matter if the stock goes up or down? That is exactly what I'm saying, Dave. And it's the simple fact of the matter. We have a position that makes money if it goes up. We have a position that makes money if it goes down. The way we do our collar trade, or at least do a protective put, we have given ourselves a 66% chance of making money on something in our position. We've actually taken the market odds of 33% or less when you're just straight directional, and we've changed those by adding a long put as protection on your stock ownership to a 66% in our favor instead of the market's favor. We don't care if it goes up or down because we understand our trading process is a process. The more shares we can make on the way down, the more profit that is as things come back. If we can make 20, 30, 40% more shares of stock on the way down, that means on the way up, you're going to have 20, 30, 40% more shares of stock than you had at the previous earnings event. Sometimes over a year, we don't make anything on a stock position, but we add 100% more shares of stock. So the second year the stock moves, you're making 100% more than you would have the year before. I'll be honest with you, my feathers kind of get ruffled when people aren't listening. I do a lot of explaining to help them understand that. Your alternative truly is someone that has the odds stacked against them or funds of some kind. Someone else out there that manages people's money goes directional. The odds tell you that 67% of the time they're going to lose. So even though they might have done great through the greatest bull run in the market history, they're going to get their butts handed to them, and you're going to lose big time sometime down the road. By adding a long put as insurance on stock, we take out that market risk. Well, Kevin, you don't always have the long puts on. Correct. There are times when you are taking all of the market risk, but you have to use technical analysis. You can't be protected all the time. That is throwing away fundamental, technical, and sentimental analysis, which are the foundation or building blocks of making your best educated decision in the stock market. And to help you out and help you understand, there are times your best educated decision is not going to be right. We did not catch Baidu at 330. We missed basically 8.6% of the downside on Baidu. But when Baidu was trading at 778 to 783, that's when we cashed in those 330 puts. We made a killing. We added shares, not as much as we could have because I was a little uncertain on Baidu. I'm probably going to kick myself when Baidu goes back up to 250, 300 after their next earnings event. But we're okay. We booked a huge amount of profit on the way down. We added, we took about 60% of that profit and we added some more shares. We also took 10% of that profit and added some more long calls. I don't care. In fact, I really want you guys to take a look at the Baidu chart. You should cheer like there's no tomorrow. That if a stock's going down, we should be cheering for Apple to go all the way back to 150. So we can add like 60% more shares of stock for the bounce higher. Kevin, how did you learn this? I learned it through trial and error in 2008. I learned it because I couldn't do it in 2000. I couldn't do it in 96, 93, 90. 87 killed me, 83 killed me. Well, Kevin, in 83, you were only 11 years old. I know. And at 11 years old, I was watching gold stocks. And in high school at 87, I was making fun of my teacher because I could make more money than he could in the stock market. Not only on the fake paper trading in class, but I had real money in it. I've been watching the stock market for nearly my whole life. And I figured out a way in 2008 to change the odds in our favor. That's why we call our trade. I don't see any other questions coming in. Guys, I appreciate your time. Next Tuesday night, I will go over the Armstrong PDF. I wanted to change this to give you some understanding of what's happening in your portfolios and why. Again, if you had more than $100,000, well, actually, it's more than $150,000 sitting in your account, and I felt you had the risk tolerance, we put a $95,000 Facebook trade on that's actually working out very well for you today. We will probably make an adjustment on Facebook because I do feel we'll get called out at 350. You'll probably see some leap long calls, 1-for-1 on your share count. For those of you that maybe haven't participated in Facebook, we might also add a couple leap long calls in your accounts so we can take advantage. We'll go with an out of money January 23 350 leap call. And I'm just taking a look at it right now. Keeve and I will go through this later on today. But for those that maybe did not get the bump of the earnings event because we felt you did not have the capital available, or through spending time with you, we just felt that your risk tolerance was not appropriate for this type of trade, we will add some leap long calls. 350, which means we're going to spend about $47, which is kind of expensive. So we're probably just going to do sprinkle 1, maybe 2 based on capital available in the account. If we did it June 23, that's probably going to be even more expensive. $57. We're going to make some decisions, although the spread is pretty big. And 46, we're going out to June. That spread's pretty tight. We're going to go out to June, and we're going to see if we can't get in that $54 range. See if people take a bite at it. Wider spread will usually help us for purchasing a position. So that way, those of you who are expecting you to get called away on your position in June, and we'll add some leap long calls that will continue to make money on the way up. Something to remember though, we might not put them all or even start today. But Kevin, you said you were going to. I said we might. We're thinking about it. But Facebook doesn't stay overbought. So we're probably looking for a little bit of a pullback before we take off long puts, before we add some leap calls. We're already not getting above the R2 resistance pivot point. We still are not technically crossed over here, and we're approaching overbought as well for big institutions on the Williams %R. So it will probably be prudent to wait a couple days. I feel sorry for all those people that bounced on and started putting positions on when Facebook today got up to 331. They're down $8 already. Oh, I got to get into Facebook. Boom. Buy Facebook at 331. Buy some leap long calls. Damn it, I'm down $8. Those are the people that'll sell their positions for a $10 loss today and hate Facebook because Facebook sucks at earnings. Well, I'm sorry, Facebook is still up $16 or 5%. Facebook does not suck at earnings. You kind of suck because you're jumping the gun and don't understand how earnings work. That would be the conversation I ended up having with someone. All right, guys, there are no more questions that have come in. I appreciate your time, everyone. Thank you for attending. And again, I'm going to go over that Armstrong right now. I'm going to do that next Tuesday night. I chose not to today because I felt this would better help people understand what's happening in their accounts, earnings, what we do here at Hurley Investments, and why. Guys, have a great weekend. I look forward to being back with you on Monday. I will hopefully, guys, thanks for being with us. I'll see you next Monday for the Hurley Investments Market Commentary. Take care, and I'll talk to you then. Bye-bye.